Thank you very much, Professor Orphanides. We have time for a few questions and remarks. Please, if you pass over the microphone first.
Athanasios, thanks so much for the great speech. I can't disagree with one word that you said. I also appreciate your pointing out honestly how pessimistic things are now, and unfortunately, I cannot give you optimistic words that you were hoping for. But I do want to add something that I think you left a little bit in the shadows, which is, and I know you were talking about Germany doing the predictable political thing, but I want to point out that there is a scenario where it could have been better. The scenario that it could have been better is that if France had decided to be really willing to share, to federalize power more than it has been. So I think that you have put a lot of burden on Germany, but I think that if there had been a willingness to really try to create effective fiscal burden sharing and fiscal reform in France and in Italy, we could have seen a much different German outcome. And that applies to the banking union too, of course. So I think, I know you didn't say anything that's inconsistent with what I just said, but I wanted to rebalance the discussion a little bit. Germany might have played their cards very differently if France and Italy had been willing to really share responsibility by fixing their own fiscal houses and being willing to set up a banking union with real fiscal shared responsibility, because as you recognize, you can't have a banking union without a resolution authority, and you can't have a resolution authority without fiscal burden sharing. So it seems to me that your talk was right, but you put a little too much emphasis on German decision making.
Thanks, Charlie. I'm disappointed that you did not manage to make me more optimistic. I will agree with you that there are a number of other things in play. So the way I was reading the Deauville decision, on the table there was also a proposal to limit national sovereignty, increase power of the central government that would have actually led us, I believe, to a better outcome. And you are right that one of the reasons why we ended up with the bad decision we saw in Deauville is because France has always been very reluctant to yield any of its sovereignty. And you cannot have a cooperative solution to the crisis without that. Let me also point out there is an element where I disagree a little bit with you on the need for fiscal sharing for the creation of a resolution authority. I view the creation of an FDIC entity in Europe as equivalent, as an economist, when I think about it like that, to the creation of an insurance setup, where the whole banking industry would be paying insurance premia. The insurance premia would be collected by the FDIC entity and would be paid out whenever there are problems going forward. You don't really need fiscal sharing in the deeper sense in order to achieve that. If the authority has tax collection power, which it does, if you actually say this authority will be able to tax deposits for the FDIC insurance premium everywhere, that tax power can be enough to fund it and also allow it to issue debt to do this. So you need very, very minimal fiscal backing to make this scheme work. But again, we see banking lobbies in a number of countries that realize that if the whole framework were common, they would lose a lot of the influence they currently have on the local authorities, and they do not wish to have that. So that's another advantage of the banking union if you were to do this, that it would actually delink politics are always present there in banking. And unfortunately, politics and banking are so intertwined in a number of member states that does not seem to go through. So again, as economists, we can say this is a nice solution. And then the politicians who need to adopt this solution say, sorry, but our supporters want something else.
I am a German, so you may not be surprised at what I'm saying now. But I'm talking as an economist and not as an advocate of German interests. So characterizing some measures as in the will as crazy presupposes to me that there is no competing macroeconomic view that makes any sense. However, I believe that there is a macroeconomic view that does make any sense and that may even be worth being considered. In particular, risk is something that is not introduced by some politicians, but risk is inherent in any credit, as everybody knows, any economist knows. And that also applies to sovereign risk, of course. There is a risk, sovereign credits and sovereign debt. So there is a risk in any sovereign debt. And the question now is who is responsible, who is liable for that, for all that. And that brings me to my point here. Because there is risk which is inherent and not introduced by some politician, the question is what are the rules of the game of the European Monetary Union? And the rules of the game of the European Monetary Union used to be, initially at least, used to be that each sovereign within the European Monetary Union is responsible for the credit risk. On the side of the demand for credit, and on the side of supply, it is simply the suppliers, the financial market suppliers of the respective credit. That were the rules of the game, and they make some sense. I admit that there are macroeconomic views that are different from that, but it's not that the one view is crazy and the other isn't. So saying that the decision was crazy is, seen from that point of view, unfair to say the least. Another remark on the unemployment rates. Unemployment rates have been going up since many years before 2005 in Germany. So they have gone out of control, more or less. So we had to do something about it. And we introduced labor market reforms in Germany in the early 2000s. And these labor market reforms have been successful so far. And that's the reason why the unemployment rates have been steadily going downwards since 2005. Would it make, I'm talking as an economist, would it make more sense to not introduce these measures and let the unemployment rates go up as they did in some other countries? Would that be good economic policy? I'm not sure.
Thank you for the questions. I have many friends who are German economists, so I'm not really talking for German economists or anybody else here. See, I'm saying that this is an episode that has been exploited by the German government that happened to be in power. This could have happened with any other country. If we just look at the influence of state politics on solving this problem. In a different configuration, it could have been Italy calling the shots. Well, we didn't have Italy call the shots. And then you would have to rely on, did the leaders take into account the welfare of the euro area as a whole or not? These are the questions we had. I would even go further and say that in the case of Germany, we had politicians in Germany in the past and chancellors who actually cared much more about the euro area. So this is not about Germany per se. This is about a specific government, how it has handled the crisis. Now let me talk a little bit about labor markets. You're absolutely right that labor market reforms could have diffused much of the pain that we see, for example, in Greece and Spain in particular. And in Spain, the government and everybody else knew that there were rigidities that had to be changed. They should have been changed before the crisis, and they were not changed before the crisis. In Germany, you are absolutely right. The previous Chancellor Schroeder introduced wonderful reforms that had paid off. The point is that when you are in a crisis and you see an economy being destroyed, it's not the appropriate solution to say, let's make things worse, and then later on say, oh, it's okay for destroying the economy because you failed to introduce labor reforms later on. We did not have to see the destruction we have experienced in the euro area in the last few years. It's unnecessary, it's man-made, and in my view, it was made as a result of the fact that there was no way to internalize the negative externalities in other countries by taking decisions that might have been beneficial to a country that could veto the whole thing. Regarding the decision in Deauville, I don't think I characterize that decision as crazy at all. I said it was a blunder, and I mean it was a blunder for the euro area. It was not a crazy decision at all. I view these decisions as perfectly reasoned, rational, and beneficial to some of the actors that take them, as I explained. And yes, there were alternatives. What happened in Deauville, if you think about it, it actually made it far more costly for a member state to be in the euro area than not to be in the euro area. If Portugal ran in trouble not as a member state of the euro area but outside the euro area, it would have gone to the IMF and obtained financial assistance from there without the threat of vetoes on the further destruction that it had to do to its economy in order to benefit in domestic politics in some other member states. That element would have been absent. And this is what makes it rather frustrating in thinking about a potential solution, seeing that some governments have been exploiting flaws in the system to make the situation worse than it had to be. Compare, as Paul de Grove has made this comparison very frequently, the UK and Spain. Why has Spain been facing so incredibly hard financing conditions during the crisis, where the UK, that started the crisis with far worse problems in its banking system and its debt dynamics, essentially faces the same cost even today as the US and Germany. This is because the UK is not in the euro area, and that's an advantage for the UK right now. And this is because Spain is in the euro area, and precisely because of how decisions are being taken inside the euro area, this is putting a tremendous cost on the Spanish economy. It wasn't supposed to work like this, and there were alternatives. However, the decisions were taken to go along this path.
Next, please.
I speak as a microeconomist, although my voice is Italian, so my accent Italian is Italian. I agree, of course, 101% with your talk in interpreting that picture, and I would like to elaborate and ask for a second and ask a question about this. Let's be, again, rigorous in macroeconomics. Those two countries, this is my way of understanding, not only a blunder, but a malicious, in some sense, action. Those two countries are forming a blocking coalition against the rest of Europe, those who experience lower interest rates. So let me say they violate the arrow impossibility theorem, and for this reason they should be rejected in the political decision making. What is the blocking coalition and the damage they are imposing on the rest of the European countries? That they can enjoy a lower interest rate, not only for their sovereign debt, but because of this term structure, they enjoy a lower interest rate for their productive system. So, an Italian company, an Italian entrepreneur who wants to ask money to a bank for investment has to pay an excessive cost with respect to their German counterpart, and this is, to me, a competitive disadvantage imposed by this structure. And why am I saying this one? Because you cannot have a very successful Italian entrepreneur with this productive structure, let's say the Ferrari, who does better cars than the German ones. They cannot ask for the same German interest rate, because they will be opposed the usual blunder, you are an Italian enterprise, you have to pay the premium of your country. So if we cannot, this is my question, if we cannot disentangle the risk premium of the sovereign debt that is assigned by this group of rating companies to the country risk from the company that is the competitiveness of the single enterprises, I think we have an unfair system, and I'm asking this question to you as well as to the German friend economist. If you want to insist in keeping this treaty in this way, we should find a way of disentangling the country risk with the corporate risk of those corporations who can be better than their government. Otherwise, we have to go, and this is my final question, to find a way to rewrite and to essentially to renegotiate the treaty on a different basis. Because the answer to that question from our viewpoint is a clear no. We cannot survive continuing to destroy our economy, paying money more than your enterprises because of this system.
So let me respond and make a few comments on this, but I have to say that I will make absolutely no stand on the comparisons between German and Italian cars. Both countries know how to make cars. No issue with me there. So you are exactly right. I did not talk about this in my remarks. The reason why then divergence in the sovereigns is so critical is because this divergence in the sovereigns that you see here gets translated immediately into divergences in the cost of credit to businesses and households in the euro area. This is what the banking union, if it were a true banking union, would solve. Then you would not have to worry about divergences in credit risk in the member states, which frankly, in equilibrium, they should be there to some degree, not really to the degree you see on this chart, but I would expect some divergences in this. They would not be influencing real economic decisions by businesses and households in the different member states. Indeed, in earlier writings, I have argued that if you look at it like that, DG competition in Europe should actually insist that the indirect subsidy to the cost of financing that firms are facing in some member states because of the current mess should be dealt with. And then DG competition does have the mandate to ensure fair competition across the member states, and we do not observe that right now. Unfortunately, I do not see in DG competition so far taking this line of argument. How could this be solved with a banking union? Well, compare the situation with the United States, where you can compare, let's say, Massachusetts, a state where I currently live, and California. It doesn't really make a difference to a firm trying to get a loan in Massachusetts if the state finances of Massachusetts are in good order or not. And a firm in California is not going to face a premium on its loans simply because the California state may be facing difficulties. This is what is happening right now in Europe, that is transmitting the divergences we see in the sovereigns to the real economy, and indeed this is the reason why it's unsustainable.
Although there are lots of questions still, but time is running out, so I'm afraid that we have to close the list of speakers. So thank you for your questions. Thank you, Professor Orphanides, for your talk, and also for answering the questions and for giving us an insight into the problems of the euro area, and let's hope that your pessimism will not be justified in the future. So thank you for...
And thank you very much. I also hope that this pessimism is not justified. Thank you.
So we have one final piece of business here. So if you'd like to stand with me. I have the distinct pleasure of nominating you, or us making you, to Distinguished Associate of the International Atlantic Economic Society in recognition of your outstanding contributions to economics. So you can see, I don't know if you can see from there, there's a clock, and it has stated here, October 2013. Thank you very much.
Thank you so much.
We are now adjourned. Thank you.